And welcome back to the Halftime Report. I'm Bob Pisani. Time for ETF Edge. Stocks and bonds both rallying this year, but it looks like investors are flocking more to the fixed income market as jitters around trade and Fed policy persist. Let's get the flow down here. Taxable bonds, that's government and corporate bonds, seeing a more than 11% increase in flows from the end of last year. Municipal bonds, not far behind, 9% increase. These are flows, not prices. And then compare that to U.S. equities, seeing a measly 3% increase. Will this trend continue into the second half of the year? Joining me to discuss this, Ben Johnson of Morningstar and, of course, Tood Rosenbluth of CFRA. And Todd, there seems to be a little bit of confusion. People seem to be positioned for a slowdown to a certain extent. No money into equities, a lot of money into bonds. Is that the right way to read the flows so far this year?
We're seeing a flight to quality. So investors have pushed down yields, and as a result, they're using ETFs to be able to take on additional risks. So we've seen high-yield bond ETFs like HYG and J&K, popular TLT, which is a long-term treasury product. But we've also seen strategies that are more hide under the mattresses. So the ultra-short products remain popular for investors that are a little bit more conservative. We've seen steady flows throughout the whole year. So it hasn't just been May, it's actually picked up again in June.
Let me pick up on what Todd was saying here, Ben. That's why I don't particularly believe in this global slowdown hypothesis, because if you look at the high yield market, the HYG, for example, fund flows have been really positive there as well, and the prices have been positive. This would be the first thing to turn down if investors thought that there was some kind of U.S. slowdown. So what's really going on here?
Yeah, investors' risk appetites have certainly improved relative to where they stood in the back half of last year. And you see that in the way that they've fanned out further on the yield curve. If you look at TLT in particular, that's been the top ranking ETF on a year-to-date basis. It's gathered nearly $4.8 billion in net new money. So top of the league tables in terms of net new inflows into bond ETFs. And then more recently, if you look at where we're at in the equity markets, the fact that we're in the midst of what's been the best June in decades, while ETFs in the equity space were sluggish out of the gate, certainly through the first 5 months of the year, what we've seen thus far in June is a noticeable uptick into ETFs covering U.S. equities, notably a pair of big S&P 500 tracking ETFs in IVV and VOO.
So, Todd, I guess the question is, are we at peak ETFs at this point? We had this enormous inflows in 2017 and 2018, 10%, 15% increases in inflows. It's kind of all just stopped except for trickles of money going into the bond fund. Are we at peak ETFs right now?
So we at CFRA don't think that's the case. We think we're going to see further adoption. What we've seen this year that has gone into money from an equity ETF perspective are those broad asset allocation products, IVV, VOO, VTI, these kind of products from iShares and Vanguard in particular. If we see the traders come back in as we started to see in June, that could really cause this so that 2019 looks a lot like 2018 and 17.
Okay, thanks very much, guys. Appreciate the help.